Looking at the Markets with David Modell. Welcome to Looking at the Markets with David Modell. I am so privileged to have the opportunity today to interview not one but two people, two excellent traders and investors, and they're part of this fantastic community of investing that we're part of. Today I'll be speaking with John Budkowski, aka and more widely known as Captain John, as well as his trusty compatriot, Miss Kimberly Swartz. Welcome to both of you. Thank you for coming and joining me today.
Hey, thanks for having us.
Thank you.
Yeah. I'm getting two for the price of one. Awesome.
That's right.
Now, he's called Captain John for a reason, and we're going to get into that in a minute, because I'm sure people will wonder, how'd you become a captain? Wait a minute. But I just want to talk about CaptainJohnCharts.com. Captain John and Miss Swartz are in charge of CaptainJohnCharts.com, and they are not only trading and investing experts, but they have some amazing charts up here. And we'll talk all about that, as well as what they're bullish and bearish on for the rest of 2017 as they see it. Now, just a disclaimer real quick. We are not in this video advising anybody on what to buy, what to sell. This is not investment advice or trading advice. You have to make your own decisions, but we just wanted to share maybe what we're looking at right now. So let's start from the beginning. Captain John and Kimberly, you're certainly welcome to chime in on this. Why are you the captain?
A couple of reasons. I was a Division I football player and captain of the football team at Northeastern in Boston, and I was also captain when I played high school, and also, although I did not actually get my captain designation, but I do have enough hours on the ocean to certainly, if I wanted to, get my captain designation. So, that's really pretty much how that all happened. Chris Kimball was kind of the one that called me the captain. So, and we all know who Kimball is.
Oh, yeah.
On stock charts. Our stock twits, I'm sorry. Kimball. Nimble Kimball. Yeah, so that's really how it all evolved.
Yeah, I've interviewed Mr. Kimball. That was a great interview. I'm so grateful for that and appreciative. And Kimberly, how did you come in contact for the first time with Captain John?
Well, I noticed some of his charts on StockTwits, which I was often on. And I noticed a lot of Kimball's charts, and they interacted with each other. And I started talking to him about his analysis and getting a little in-depth in his techniques, because I wanted to craft what I was doing and see a bigger picture. And that's how that all started, with the charts.
Sure, absolutely. Do you both of you have any mentors that you'd like to give a shout out to as you developed as traders or investors?
Well, probably for me, when I first started at Morgan Stanley, over 20 years ago, when I first got in the business, I mostly did mutual funds and municipal bond business, and then I found as after maybe a year or two, people started wanting to get into individual stock investments. And what I found was that I never really got anywhere with the typical research that a big Wall Street firm puts out, and I got very frustrated. And all of a sudden, there was a guy that had started in the business, I think in 1956 or 57, something like that, that came back. He had gone to Bear Stearns. He'd been at Goldman Sachs. He'd been everywhere. But this guy was what they call a technician. And I'm like, well, what is that? And this guy was a life-changing person, because everything, not everything, but most of the things that he would recommend did extremely well. He talked about relative strength. He talked about sector rotation. He talked about all those sorts of things that we know about. And so I learned a lot from him. And I'll tell you, he a quick story is that one of the investments that he recommended I bought. I think it was Intel, and it did very well and in a very short period of time. And this is back in the mid 90s maybe. And I bought it, and it went up, about 30% in a very short period of time. And the analyst had a target, the fundamental analyst had a target of 60, and so it hit 60, and I called him and I said, hey, and I had an open door conversation with him all the time. And I said, hey, should I sell this? And he was like, no, it's going to 95. And I said, well, how do you know that? And he said, well, because the point and figure chart says it's going to 90. And he goes, I don't know what that analyst is talking about. It's going much, much higher. And it did eventually. So I never sold it, and I held on to it. But I didn't know what a point and figure chart was. So I went in and talked to my manager at the time, and I said, hey, what is a point and figure chart? And my manager said, well, I haven't seen those in 25 years. And it was just a really weird coincidence that back then we weren't allowed to use email, and so we had to do everything by fax. And I got this report that I happened to sign up for from the Philadelphia Stock Exchange, and it had a bunch of X's and O's. It looked like a jigsaw puzzle, tic-tac-toe, whatever. I mean, I was like, what the heck is this? And it was a fax from Dorsey Wright. And long story short, I ended up buying Tom Dorsey's book on point and figure charting, and that completely changed my life. And I read it over probably 2 or 3 times, and became very well versed. Eventually, went actually down to Richmond, Virginia, to spend a 3-day weekend with their program that they run for investment managers. And so that's really, and the guy that was my mentor, I got to give him credit and his name was Lou Smith. But that was many years ago, and the guy was fantastic, and he changed my entire investment career.
That's great. It's great to have mentors to guide you along your way, and you are now serving that role yourself, mentoring other people. You and Kimberly alike are helping so many people with your amazing charts. I'm looking at CaptainJohnCharts.com right now. I see on there, on one of your charts, it says, trade what you see, not what you hear. What does that mean?
Well, what that means is that, to me, a lot of people that fail, they fail because they listen to news, they look at magazines, they look at the newspapers, and that can be very misleading, because if something is working, it's working for a reason. And you always want to try to position yourself in the right sector. You want to be in the market at the right time. Not that we're day traders, we don't day trade, but and not that day trading's bad, but we that's not what we do. But oftentimes, I think one of the most important things I could tell investors is to watch when you have a market that is in a decline, for whatever reason. If the market stops going down on bad news and starts going up on bad news, that's a great place for you to enter the market. And conversely, if you have a market that is going up ballistically, like we've had, for the past few years,
right,
then, at some point when everybody's in, there's no more wood to put on the fire. Okay, everybody's in. So I think if I could just say that one thing, That's probably the most important point I could make.
Absolutely. And you and Kimberly have achieved amazing results. I'm looking on CaptainJohnCharts.com right now. It says that the total return of just one of your many strategies, 558.3%. That's incredible. And I realize that returns are not always going to look like that. When people go to CaptainCharts.com, you and Kimberly can both perhaps jump in on this one. What can people expect to see on the website, and what kinds of returns can they expect consistently?
Well, of course, that's going to depend upon what the market gives you. There's times that I've always thought, or my experience has been, that you get a couple times a year to really rack up returns. Sometimes, and you have to understand that sometimes the market's continually trending. Sometimes the market goes sideways. And we've adapted our strategies so that we sometimes love buying breakouts and new highs. And there's other times that
Pairs trades.
There's pairs trades.
And then there's knowing when to defend.
Yeah. So, I mean, sometimes if you get a market that's not trending, then you need to buy dips on support and sell the rallies. When markets are breaking out, then it's so much fun, right? So, I don't know. Can you add to that?
It's just knowing you have to back to trade what you see, not what you hear.
Yep.
It goes back to that major theme that you should always know where the money's going. Follow the money.
Yep.
That's when if you know, then you know technical analysis helps you with your entries and exits. So you craft that. And things like with John's SPX chart, the 6 month, 10-month strategy, and pairs trades, if you can get every inch in the game, you can topple and win the game. So people get greedy and they overplay and overstay, and that's where you get into trouble. And that's why we're here, because we don't want that to happen to people.
And
John's seen that.
Right. Overplaying and over trading means overpaying. I like that. It's easy to remember, and it's so true. Now let's talk about 2017. Some say the markets look a little toppy. There's been some signs of weakness recently. Just talking about the spiders, the diamonds, the Qs, and so on. What are you guys bullish on right now? Are you looking at equities, gold, commodities? What should we be in with the understanding that we're not telling people what to buy, what to sell? What are you long and what are you short right now?
Okay, well, on a relative strength basis, if you take a look at all the asset classes, we like to look at U.S. markets on the stock side, U.S. bonds, international investments, whether it be developed markets or emerging markets. Look at currencies and commodities as well. And right now, it still the U.S. market still is the #1 place to be on a relative strength basis. Now, the chart that I sent you, it just shows a very long-term monthly chart showing that right now the 6-month and the 10-month switchover, moving average switchover system is still very bullish on U.S. stocks. And even though you and I both know that things have been kind of flat for the last month or two after the rally, the pre-election rally, but it still is very bullish. And if you look at that one system, you would have done very well for yourself over the last 15 years, as opposed to most people being probably flat to slightly up.
Right.
So we're bullish on U.S. We're still bullish on U.S. equities, and if that changes, well, in terms of sectors, we love the home builders. We like biotech, And
I love the Internet of Things space and AI space. That's, if you look at Microsoft's chart, it's very bullish, very beautiful. There's a lot of things still working.
Fantastic. And what I will do is I'll try to put up in the video the chart that Captain John is referring to. It looks like a monthly chart of the S&Ps or the spiders if you prefer the ETF.
Correct.
It looks like the 6 month is that a simple or exponential moving average, and the 6 and the 10, am I right?
They're just simple moving averages.
Okay.
They're not exponential. But it doesn't matter. I mean, you get the same idea on either one of them.
What's so powerful about the moving average crossovers? Why do they work so well?
Well, on the long term, it took you out before the dot-com collapse, or not. I mean, not exactly at the top, and it put you back into the market, and then it took you out during the financial crisis. Mm-hmm. So the key to me, the other key, besides what I mentioned earlier about having successful investment returns, is more important than anything is not to lose money. And I didn't coin that. Warren Buffett did, right?
Right.
That was his number one rule.
Yep.
And the number two rule is don't forget rule number one.
Right.
So, right, we don't want to. If you ride something down 50%, you have to have 100% to get back.
Yep.
If you ride something down 90%, you have to have a 900% return to get back.
Right, and that's about also you can know what to do, but not always be able to do it. So you have to be so solid in your strategy and your structure of knowing when it's time to leave. You just go, and you protect your gains at all costs. As if you need to last another day is what you have to feel.
Yes.
And you're dealing with clients and a larger sum of money than a smaller portfolio. We have all sorts of strategies for making sure we're going to defend every gain. We don't want to leave anything on that table.
That's great. There's so much good advice there, so much food for thought. Just rule number one, protect your capital, don't lose money. Rule number two, from Warren Buffett once again. Rule number two, see rule number one, and live to trade another day. That's what.
Don't overstay. And
don't overstay. Wow, so many. I should print up T-shirts or bumper stickers. Got so many great sayings here.
How about some hats too?
Yeah, that makes some hats too. So you've got weekly reports, live webinars. You got a chat room. What do you have a free trial or any special offers going on right now?
What we're going to do over the Easter holiday in celebration of Easter in our 500th post, we are going to put up a special discount for 50% off, and they're free to try for 30 days, and they can cancel at any time, but I bet they won't want to.
Mm-hmm.
No, they won't.
Yeah. Wow. That did you say 50% off? That's quite a discount.
Yes.
Fantastic.
Yes. We're very giving, and I was mentored in this community of giving, and I wish to remain in a giving manner for people because that's what helps you excel is all the free knowledge, and then you help. If you need help, you let the professional take you all the way.
Yeah.
So you can get there.
That is a great policy. And let me ask you this: for retail traders, so many of them fail. So many of them, buy at the top and then sell at the bottom. It really, as an educator, and you're educators too, it really bothers me. How can people, especially retail traders and investors, how can they do better?
Well, first thing is turn CNBC off. Stop looking at magazines. Stop looking at any kind of financial media, because if you do, you're going to become biased. And when you become biased, you marry things. And there's nothing wrong with being married.
Right.
I think we all know that. But you don't need to marry stocks. You don't need to marry bonds. You don't need to marry country funds. You don't have to, and when they go down, if you made a bad not a bad decision, but let's say you made a wrong entry into something, you got to have a reasonable exit point. You don't write it down. And what most people do is they become married to something. Yep. Well, they become euphoric, and they
Tesla was very euphoric from 33 to like 120. The euphoria was overwhelming. I'd never seen anything like it. And that made people stay too long when they should have protected their gains. And that's what happens. And you need to be solid in your exit and stick with that plan and perfect that. Entries and exits. The perfect entry, the perfect exit. Get the most you can safely, and then protect what you've built.
Right. That's a great point. Entries and exit points. I think retail traders don't think about those things enough. They just think about how much money can I make from this, and not what do I do if it goes against me. What do I do? And these are things I believe you should know beforehand, before you even make the trade or while you're making the trade. Are you in the camp that adheres to let your winners run and cut your winners short, or what is your philosophy on that?
I can't believe you just asked me that. I was just about to say to you probably the number one old adage on Wall Street is cut your losses short and let your winners run.
Right.
And so here's the thing. We all have heard, probably everybody, even people that don't invest in the market, everybody's always heard the adage of buy low, sell high, right? But really what that means is it's not buy low, sell high. You don't necessarily buy something that fell 50% because now it's 50%. It's not like buying a gallon of milk, right? It's 50% off. It doesn't work that way. What buy low, sell high means is you want to buy low expectation and you want to sell high expectation. The price doesn't matter. The stock price doesn't matter. Like, it doesn't matter if it's a $10 stock or a $1,000 stock. But buying low expectations and selling high expectations is what matters. It's not because if you simply think that because something fell 30%, 40%, 50%, that it's a buy, okay? It's got to buy. It's a buy when it's a low expectation stock that has fallen into support on a long-term basis. Then you can feel comfortable of dipping in. It's not simply a matter of you got 50% off on a T-shirt at Target. Okay, so that's what people that's one of the other big mistakes people make.
Another one we've talked about is price. You're tempted to trade stocks that are lower in price because you feel like, oh, my portfolio is only so big. I can only buy so many shares. Well, it doesn't matter. You're still, if 20% is 20%, whatever the price is, why take on so much risk? Sometimes those are just way too risky, and I know from experience. So I was in Plug during the lefty. He came out with some negative news, and it was a risky stock. I knew my exit, and I took it, but other people did not. They continued to cheerlead it and be married to it. So all these things kind of work hand in hand. Did you notice that? It's all a mindset.
Yeah. Mindset is so crucial. Are there any? Let's get down to specifics because people love to hear these little tips and again, we're not giving financial advice on this. We're not telling people what to buy,
Correct.
what to sell. But are there any companies or stocks right now? And I don't like to give hot stock tips. That's not what I'm all about. But is there anything that people just aren't looking at right now that maybe they should?
Well, perhaps Flex and J-Bill, in that once again in the IoT sector.
Yeah, Internet of Things. Yeah.
Yes, the Internet of Things, deep semiconductors.
Semis. Okay.
Look at the things. That's where having a great knowledge of that sector can really benefit you, because you can foresee as a visionary how things will become. And if you understand that, it helps you look at, like hone in on the sector and start looking at the technicals and the charts.
Yeah.
And that can really greatly help you. I think that's a great sector that has massive projections of revenue.
Okay.
That's going to dwarf the GDP of Germany. So that's definitely one of those areas that I'm all about that, and the future, the virtual reality. Look to the future.
Sure. How about recently I've had the privilege of getting to speak with gold and silver stackers. People who like to hold on to. They like to have something physical they can hold on to. Are you guys stackers yourselves, or do you trade gold and silver in your portfolios?
Not right now, but I did stack silver and gold, and I sold it as it started hitting the highs. It started getting sold. So, and people were, I would talk about the technicals, but again, people, they feel comfortable. There's just certain people that feel comfortable generation after generation holding gold and silver, and that's okay. There's going to be long periods of time where that's not in a bull market. So you're holding it, for your daughter, maybe, for their daughter, but there are times when you should be selling it when it's rising. But, some people, they should have their bank and their stack that they keep, and then one that they sell for the profit.
Interesting approach. I like it. And finally, because I know, I don't want to take up too much of your time here. I'm just so grateful to be able to speak with both of you today. Geopolitical events lately have gotten the market a little bit skittish. A lot of retail traders are thinking about selling, or just going into cash or whatever. When geopolitical events heat up, does your approach to investing or trading change, or do you keep it the same? And why do you keep it the same, even though things are changing so much in the world right now?
Yeah, well, I can tell you this. Again, let's go back to price, and that's all that matters. So we obviously had a lot of news this week, right? We dropped a big bomb in Afghanistan. What happened? Did the market go down that much? No, not really. So the important thing to remember is that there's all kinds of events, and we will have a lot more of them in the rest of our lifetimes. It depends on how the market reacts to the events. If you see a major event that you say, "Oh my God, I got to get out of everything. The world's coming to an end," and you see the stock market not going down, there's your clue, right there.
It's a resilient market, and it sounds like you have a method and a technique and a plan, most importantly, that does not rely on every little piece of news that comes out, every little article that somebody writes, every analyst upgrade or downgrade. It sounds like your strategy is solid no matter what else, despite all the noise that is going on in the world. Would that be accurate?
Absolutely, and I'll give you one quick example.
Sure.
After 9/11, okay, of course the market was closed, I think, for almost a week, and then when the market reopened, the Dow was down, I think, about 700 points, and everybody thought the world was coming to an end, and of course there was a lot of fear. Naturally, that's only human. And then all of a sudden, we had anthrax. And guess what happened? The stock market started rallying. And then the next day, another anthrax. Now we're all going to die from anthrax. And the market continued. And if you missed if you didn't realize that the market turned, I don't know if it was the market discounted everything. That's probably what happened. But you need to find points when everybody's in fear and the market turns up. That is the best time to invest.
Right, like right after the election, that was an unexpected turn for a lot of people. You missed 11% watching it.
Right.
So.
And it all comes back to trade what you see, not what you hear. A sound investing
Absolutely.
and trading. Yep. What a sound and solid trading and investing strategy. Just wanted to wrap it up with just to remind everybody to visit CaptainJohnCharts.com. If people want to tap into both of your insight and knowledge, besides going to the website, is there any other way that people can contact you right now?
You can reach us on Twitter at Fortuna Equitas or Captain John. That's posted on the website. You can also find us on Facebook. We're all over the place. We're on StockTwits with Captain John or Fortuna Equitas. And the website has a list also of our phone number and our email addresses, so you can contact us if you have any questions at all. We're always here to help you, no matter what.
That sounds great. I don't see why people would not take advantage of that. Check them out on StockTwits, Twitter, and of course at CaptainJohnCharts.com, and I'll be putting those links in the description of this video. Thank you both so much for joining me today. We got past all the technical problems, and we had a great interview, and I really appreciate it.
Hey Dave.
Yes.
I just want to tell you you're a great guy, and appreciate you having us here.
Yes, thank you so much, David.
Thanks a lot to both of you. Everybody check out CaptainJohnCharts.com ASAP. Thanks a lot, guys. Appreciate it today.
Thank you. Have a great afternoon.
Have a great Easter.
You too.